Okay, boom. We are expanding off of episode 8 today. We are on episode 9, and we introduced last episode basically the destination for where we want to go in the market. And now we need something that is able to help us identify how we're going to get there. We need to be able to understand some concepts or confluences, as we call them, for ways that we can get to this point uh, as a draw on liquidity. You probably think, oh, great, I know where the market's going to go. I know that these things are the things that market is attracted to, but you have no idea how to actually enter or take a position towards that draw that we talked about. So today, what I want to introduce to you guys is going to be these couple things. I already drawn some things out. We have these, which is a fair value gap, and then we have the opposite, the inverse of that, which would be a inverse fair value gap. And you guys are probably seeing these, and you're just thinking, bro, these are literally just candles. What do you mean they have formations, or what the fuck is a gap? Well, I'm going to explain that. A fair value gap happens when we have three candles inside of the market. And they don't have to look like this. It can be either like this or it can be bearish. I could show you guys an example of that afterwards. But it happens when we have three candles. Just ignore this fourth candle that we have right here at the moment. I'll circle it right here. Just ignore this one right now. We just X that one out for now. Just put an X through it for the moment being. Don't mind that it's there. Just keep your attention on these. So we have three different candles right here. And what did we learn from the first episode when we were learning about candles? We learned that they have four parts: this, this, and this. And if you remember, we have the low, we have the open, because this is a bullish candle, and we have the close at the top, open at the bottom, or open at the bottom, close at the top, and then we have a high right here. In this formation, what we are worried about is going to be the highs and the lows of these candles that we have right here. And specifically, we are going to be worried about a certain two candles, highs and lows. So we are going to be worried about the first candle that we have right here. We're going to be worried about this candle's high, and we're going to be worried about not about the low necessarily of this candle. We don't need to worry about the low, but we are going to be worried not about this second candle, nothing in this. We are going to be worried about the low of this candle, the third candle in the formation. And now the candles in this formation do not matter. You could have a couple of bullish candles that are blue, and then in the middle you could have a bearish candle as well. We do not matter about the color of these fucking candles. We do not care. However, I don't think it'll work if we have it like this. Yeah, I'm pretty sure this shit will not work. I'm literally just realizing this now because how is this going to line up with a gap? Yeah, this shit is not going to work. So we need to have three different candles that are all either bullish or all either bearish in a row, basically. And that's how we are going to have a formation of candles. And basically, in this formation, we are seeing a lot of buying pressure, as we are seeing, because these are up candles and these are blue candles, as we've learned. We are seeing a lot of buying pressure, and we're not seeing as many people that are putting in orders for the market to go downwards, obviously, because we are moving upwards and we're moving higher. But in this case, we are seeing an imbalance of the amount of people in either direction. So we're seeing an imbalance in the amount of people that want this market to go upwards because it's moving so fastly upwards. We're seeing so many orders going up, and we're not seeing as many orders going to the downside. So when price does this, what are we focused on? We're focused on the first candle's high and these third candle's low. And in between these, we can see that if we take our rectangle tool that we had drawn out, I'm going to get you guys to copy this. If you put the background to this color, put the border to this, and this thickness and this line style, and then the I have the middle line turned on. It probably won't be turned on when you have it on, but this is the settings for it. And then I click extend right, and I'm an idiot and didn't save it. So let me redo that for you. But make your box look like this. That's what I want you guys to do. And then if you have the magnet tool on, we'll show you how to use it on the chart afterwards, but you're going to want to take your cursor and you're going to want to place it on the high of this candle, and you're going to want to place this this other point that we're moving right here with our cursor when we clicked on the low of this candle right here. And this box right here that we just drew out, it's called a fair value gap. And when we have a fair value gap, we are looking for another candle right afterwards, this candle that we X'd out. We're looking for a what we call a retrace candle to come back down and come back inside of this fair value gap. Not extend this, boom, okay. This candle right here, if we have it come down and maneuver itself into this gap right here, that is what we would call a fair value gap. And there's such thing as a respection, like a gap getting respected, and then there's also such thing as a fair value gap getting disrespected. And then if it's disrespected, in turn, we get a inverse fair value gap, as I'll show you over here. But in this case, when we have a down candle come right after this, or maybe we have a couple of more up candles, and then we get a down candle that maneuvers its way into this gap, normally we'll see when price is playing out, it'll move up and down, and we're not worried about the wick of this candle. If the wick comes down and moves through the box like this that we created, it's still respected. The fair value gap is only disrespected when the fourth candle that we have here, or whatever number candle after the formation comes, and then we get the retraces down into the gap. We only care about when the body will close below, or if it closes in the gap. If it closes in the gap, it's completely respected. And then we can see another candle right after this come straight back out and go straight back up to the upside. And it could be a blue candle that goes straight back up to the upside. And that would be a good example of a fair value gap getting respected. Now, however, if I show you, and it doesn't matter about the wick, we don't care about the wick, we only care about the wicks when we're drawing them out, when we're drawing out the gap. When we have the gap actually being retested into, or the gap being pushed into by this candle right here, we do not care about the wick. The wick could come all the way down here, blah, 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 whatever. As long as the candle retraces back up into here and it gets a closure back into here, that would mean a respected fair value gap was formed. Now, however, if we move on over to this candle formation right here, what do we see? Well, I'm going to take it from the high of the first candle and then the low of the third candle. And I'm going to place it just like this. And I'm going to re-put back on the settings that we had, just like this. Okay, so we see that the fourth candle that we have right here, it came down, and what did we get? We got a candle body closure outside of the gap. It came down and it closed below the gap that we had right here. It closed below this line right here. It's not inside the gap anymore. It is currently a disrespected fair value gap. And this is very valuable information that we can use, because if price wanted to go higher, what would we want to see? We'd probably want to see the gap play back up into here and then maybe get a wick that is really long and maneuvered all the way back up into here. And we saw buyers fighting to keep the candle inside of that gap, and then we would see that we got enough buy orders to push the market back up into this gap, and then we would probably want to go higher from there. And we can see through other confluences that it would want to go higher. Maybe. It's a potential. These things are potentials. These things are just things that we use to give ourselves a probability of knowing exactly where the move will end up taking us. So if we see that the gap gets disrespected, then we can see, okay, we were wrong about the idea of price wanting to stay up into this gap and then move higher. And we had enough buyers that were able to counteract the sellers that were able to counteract the buyers that were pushing this move up so aggressively. And then we pushed back down into the fair value, and then the sellers were able to get their orders filled to push it further downwards. And we'd probably want to see continuations downwards from this move, and we'd probably want to see the market go lower. But if we were to respect this gap like we did here, jeez, bro, then we probably want to see market go higher from there. So with all this being said, I'm going to erase all this, or maybe not erase it. I'll keep it on there for now. But I will show you guys from today actually some examples of some fair value gaps getting formed in real time. So I think I'm in bar replay already because I just did a recap. But if we see on any time frame, we will be able to see this. We will be able to see on even the monthly time frame a fair value gap getting formed. So if I scroll out here in the monthly time frame, I will be able to see even right now that we are maneuvering and making a fair value gap, basically. I did not show you guys this, but it can consist of any different type of candle on the bottom and the top. It just can't consist of a different colored candle in the middle of the formation, basically. So from here right now, we have what? The 3 candles that we want right now. And you're probably thinking, oh, well, what did we just tell me to do? Well, I told you to look at this high and the low of this candle right here, even though it's pretty hard to see. It's right at the bottom right there. And I told you guys to take your cursor and go like this and mark it out. And boom, that's how you mark out a fair value gap. You just take your cursor and it locks on because you have the magnet tool on. It locks onto this high right here. You click, and then you go up to this high right here, or this low right here, and it locks on, even though your cursor is a bit messy. You click, and then boom, it puts it on for you. You probably think, I just marked out a fair value gap. You're wrong, idiot. Okay, why are we wrong? Because this candle right here, for this monthly, has not closed yet. So what can happen within this candle? We already know when market is playing out, we can get a candle that makes a wick and moves us all the way back down to here maybe, and then what would we have? We would have nowhere to put our fair value gap. So that was kind of a trick example of where we saw a fair value gap that got placed, but isn't actually true yet because the candle has not formed. That is our 3rd candle. That is one way where people can get messed up on fair value gaps. However, let's look throughout this whole move right here. You're probably thinking, oh, we have a bunch of up candles right here. We can't have fair value gap. It's got to be 3 candles. Well, no, we can have 3 candles within the same range that make a bunch of different fair value gaps, or maybe just 1, or maybe just 2. So if we look throughout all of these moves right here, I can form about 3 different fair value gaps right now that I can see. I can see a fair value gap from these 3 candles right here, from this high up to this low. I can see one right here from this high up to this low right here. And I can also see one in the opposite direction that was inversed actually and went up to the upside, but I will show you that in just a moment. So we're on the monthly time frame right now. And what did I just see with market right here? When we are having fair value gaps like this is a good example as well. If we have fair value gaps like this, and we have 3 candles, it does not need to be on the very next candle that we come down and we retest it. It just needs to be that we have a downtrend that comes down, maneuvers downwards in the market, and then we end up getting a wick from this candle right here. It does not need to close inside or above. It just needs to have a wick, or it can get a closure in the box. It just needs to tap it. That's all we need to see for a fair value gap to get respected at this moment. So what do we have? We have 2 different fair value gaps right here. So if price wanted to, it could have come down. It could have disrespected this first fair value gap that we have, because these are stacked up fair value gaps, and they're in the same leg of price right here. We could have price come down into this first fair value gap. We could have seen it get disrespected. We could have seen this candle fully close underneath or even down here, and it could have still disrespected that. But then what would we want to see? We'd want to see price come down and hit this second fair value gap. And if it hit the second fair value gap and disrespected this first one, it would still mean that price can go towards the upside. And that is a good example. If we had like 3 different fair value gaps here, say we had another one down at the bottom right here, we could have still seen price disrespect this one, but until it disrespects this one at the bottom, it's not a inverse fair value gap setup, basically, because it has to inverse the bottom one on the range before it's invalid. And I'll show you what I mean by that in a moment. But ended up coming down, we filled this fair value gap with this wick, and then we ended up rallying higher to the upside. Okay, boom. That was a good example to the upside. But what did I mean by that example? I'll tell you in just a moment. Just let me show you this example of this fair value gap that got formed and then disrespected. Okay, so boom, we have these candles right here. We don't actually have our thing yet. Let me go to this. Okay, boom. Okay, we got a fair value gap. Let's just ignore that this candle even formed yet. But we got a fair value gap right here. What can we expect? We can expect either price to come into this and then get a reaction off of it and come back down to the downside to continue us down lower. Or if we close above it and we have a candlestick closure above this level right here, this line from the gap, then we can consider that price might want to possibly go higher for these highs right up here to this draw on liquidity. So what do we see? If we play out price right here until the candle closes, boom, what did we end up doing? We ended up coming up, and we got the body of the candle closing above this this level right here, which is the fair value gap. So we ended up actually inversing fair value gap. This would be an example of a inverse fair value gap, IFVG, as people like to call it. Boom. That would be a inverse fair value gap that we got. Okay, just give me one moment. I'm going to find a example of the other thing, and I might have to swap time frames for this because it might be hard to find this. Okay, no, it's actually literally right here on the monthly time frame. It did not take me long at all to find that. So if we look at this leg in price right here, we can see that we have a couple of fair value gaps that stand out to me. So if I'm looking here, I have a couple of candle formations right here. I can see that we have these 3 candles right here, and then I also have these 3 candles right here. So we have these 3, and then we also have this one, and this one. A couple of candles can make 2 different fair value gaps, as we can see right here. So I take it from the high of this candle up to the low of this candle, and then we also take it from the high of the candle that we marked out to this candle right here. And all that's required is we see this gap and this space where there's no wicks overlapping each other. If there's wicks overlapping each other like this, we have nowhere to draw the gap because we can't draw it below. There's no way to draw it here. There's no gap in between the candles and the wicks. Sorry. So you can't draw a gap from here down to here. You'd have to draw the gap up to like here, and there would have to be a space in between the gaps and this candle, and you overlap over top of this middle candle. That middle candle's body does not matter. Okay, so what did I mean by we can have one fair value gap get disrespected in a leg, and then have a second fair value gap on the bottom that price actually wants to come into? Okay, so this is a great example of this. So as we can see, we have one fair value gap up at the top right here, and then we have this second one right here. But what did we do to this first gap right here? Well, on this candle, we had a closure below the gap and we ended up inversing it. Well, that's not good. Okay, so what can I do? I can click this one and click delete. It can come directly off the screen. This one is no longer valid. Not anymore. But since we had a leg right here that was straight up candles, and we didn't have something like a down candle right here in the same leg, then it means that we have stacked fair value gaps. And we have another imbalance of buyers to sellers in this market right here, where price can retrace lower into and come down and get more orders to be able to fill it to the upside. So we end up getting a closure inside of the gap. We don't have the wick come down below the gap, even though that doesn't matter. We don't have a closure below the gap like we did in the previous one up here. And then we get a straight reaction to the upside and price ends up going higher to the upside. And we can see on these fair value gaps, we can see that they're really clean, that they get really good reactions because we are on a monthly time frame. And the monthly time frame holds more power in this case. So in this case, you can see that fair value gaps get respected and really played off of really well and really nicely because higher time frame holds higher power. However, if we were to scale down to something like the 1 minute, yeah, sure, we'd be able to find gaps, but we'd see that more often than not. We can see that they get inversed a lot more often. We can see that some of them aren't as valid as others, and some of them don't work as well. But we're looking for gaps that can actually get played off of, and then gaps during the day that we can take a position off of. Okay. And then what's another thing that I want to talk about right now? I want to talk about currently the gaps that get left behind in the market and don't actually need to be filled at all. Okay, so I want to bring your attention over to here in the market, if I can. And we'll just bring us back this way. We'll delete this because it's no longer in here. And then, as we can see, we have this big bearish move that comes into the market down, down, down this way. Okay, so in this move, I can see a couple of gaps. I can see bearish gaps that go to the downside like this. We have these 3 candles right here that end up forming a gap. And then we don't actually have any more gaps until actually down here. But these 2 gaps are not correlated at all. So I just want to bring your attention to this gap right here. Actually not a good example because we did get this tiny little wick into the gap and then we ended up reacting off of it. But there is going to be some times when a gap never gets used, like down here. And then we see that we have a bunch of gaps in this space right here. Boom, 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 like this right here. We can see that we have 3 different gaps that we have right here. And then we get reactions down into one of the gaps right here off this candle. And then we get reactions higher to the upside. However, when we see that market gets a reaction into a group of gaps, like 3 gaps right here, as soon as we get a reaction out of these gaps and we actually react off of these, and we see that market starting to go higher, like around these candles up here would be the point where I'd say that these gaps down here that never got tapped into when this move happened right here don't actually matter anymore. They don't actually need to be used at all. So we can see that market, yes, it comes back down over here to reuse this gap maybe, or maybe it was just sweeping liquidity right here from this draw that we had. But however, as soon as this gap gets used, or this set of gaps gets used, then they are no longer needed and they are all useless to us again. So as soon as these gaps get respected, or the first gap gets respected, that means that price only needed to come down and use it right here. We're not waiting 4 months later for these gaps to get used. We're not waiting until, April of 2022, or we're not waiting from May of 2022 or 2020 to reuse it maybe in 2026 over here, right here. We're not using a gap from 2020 to be used in 2026. It's just not happening. It's just not happening. You're only going to see that gaps during the current move that we're having are the ones that we're reacting off of. So we can see right here, this is pretty reasonable because we got reactions off of it. And then what did we end up doing? We came back up and then we disrespected it. And price probably just wanted to sweep liquidity right here, but we already got the reaction off the gap that we would have wanted to take a position off of. So the gap, as soon as it gets reactions off of, or as soon as the group of gaps gets reactions off of them, then they are no longer valid at all, and then you just don't use them anymore. Boom, boom, boom. Okay. I'm going to leave bar replay mode right now. And then I'm going to show you guys that these gaps can be used on any singular time frame. So we can scroll down into the 4 hour, and I will show you guys gaps that we got used even during this week, actually. So if we show even just today the gaps that we were reacting off of to take trades, we can see that we had this gap right here. Just looking at it, we had these wicks come down and fill, and then we ended up maneuvering up to the upside right here. And then what are we going to do? We're going to say that this gap was already used and we were able to respect price, and then we were going to go higher for the day. Go down to the hourly time frame. We can see that nothing like this got used. No gaps, no gaps. On the hourly time frame for the S&P 500, I just switched indexes from the NASDAQ to the S&P. We can see that coming into today, Thursday, we had at 9 a.m. and 10 a.m. and 11 a.m., we formed a gap right here that we ended up coming down into with this wick right here. And then we got reactions off of it right here on this candle, moving us up to the upside. And then we are moving around right now, but we could assume that we might want to go higher or we might not. We just know that price reacted off of this gap and then it got used. So it is no longer needed anymore. We can find gaps on the 30-minute time frame that we marked out. We can see that we have gaps over here that were never even used at all. But are we waiting 10 days from Wednesday 13th, or are we waiting from Wednesday, May the 13th, yesterday? Are we waiting for another trade or another thing to come back down into this gap and retest it and then maneuver back up to the upside or inverse us? No, probably not. We'll probably want to maybe use a gap like up here, right here, that we are able to actually use within a current leg within the market that has already happened. And we can see that we have a group of gaps right here, and we can get rid of these. We have a group of gaps that got used. We got this gap right here at the top. It wasn't enough for the sellers to come back down and retest. So we came back down, we got a closure inside of this gap right here, and then we had retests. But as soon as we disrespect the gap on this candle right here and close below this gap right here, we just delete it right off the screen. Boom, it's gone. And then as soon as we get reactions back up to the upside on these candles, we delete it again and we say, you know, this gap was respected, and we can say that we no longer want it. We can go down to the 5-minute time frame, and we can see that we have a bunch of gaps that get formed now during moves. So boom, boom, we have those gaps in that formation, and then we have gaps even up to the upside right here. So boom and boom. This is messed up. Yeah, like that. Boom. Okay, we have gaps right here. We get retests into it, and then we move higher. So these gaps no longer matter. We're not looking for this gap when we come back down into this range right here, even though it does get a little bit respected, but you know, it's not what we want. We can see that we get moves all the way back down to here, and then we disrespect this gap and get pushes down into this gap right here. We can see that we have inverse fair value gaps that get used and then move to the upside, or we get inverse fair value gaps and then we move into another fair value gap that's right below it. So we can see on the 1 minute time frame that even here we have a 1 minute fair value gap right here that's currently getting respected as we speak within the market. Boom, like this. Okay, so hopefully this was able to actually help you guys in the market with identifying these gaps and inverses, and hopefully next time we can get into some rebalances and more things that can show us the market rebalancing and moving within these different confluences that we can use to take positions. And then hopefully soon we'll be able to get into the entire strategy and the way that we can execute. So thanks so much for tuning in. Hopefully you guys were able to understand this, and I explained it hopefully well. But homework, if you guys can, make sure you go onto your chart and try to find at least one set, maybe take screenshots of them, of maybe a group of fair value gaps on one time frame. If you have to scroll back a bit in the market and do that, make sure you do it, and then take a screenshot of it, memorize what it looks like, get really used to identifying these things, maybe do it a couple times, and do like 2 or 3 of them, take screenshots of them, put them in a folder on your PC, and just rewatch them, reread them, and then if you ever forget what they look like when we're trying to learn, you guys can understand and know and look back at what they look like. So try to find one on each of these time frames right here. Try to find like a group of them. Try to find one getting inversed, one getting respected, and then price going higher from it or price going lower from a inverse, and just keep screenshots of them on your PC and label them. Put them in folders and organize them. Don't be lazy. Just do this homework. I trust me, it will help you. And then you won't even need it in the future. You'll be able to just spot these things and you'll be able to understand them. But for now, you're probably going to need to, reread these a couple times. But peace for now.